Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be doing another stock recommendation, and this one was actually brought up by Mauricio Besserell, where he pretty much just said, was wondering if you could do VFC next, which is another clothing brand. Now he actually commented this when I did my buckle analysis, so I know it's been a bit, but I still would like to give you guys any analysis that you might recommend because, well, I am a servant to essentially all of you guys. So guys, let's actually analyze VFC, which is the ticker symbol, and see if maybe at the current share price and looking of course at other fundamentals, coming up with a discounted free cash flow approach, we would like to buy this company at today's price. So with that said, let's get started with this analysis. Now, before we actually move into even the dividends, I would actually like to point out something, guys, that you probably saw in the thumbnail. Well, this is essentially a 52-week low stock. So yeah, we are actually buying this, assuming that we would like to buy this, right? We're technically buying this at a pretty low price at around $41.43. So you can see here on the year, it is down 46.18%. And on the year to date, it is down 43.8%. And seeing that their 52-week range is between $40.69 to $78.91. Yeah, guys, we're essentially buying this at the 52-week low. So let's actually see what we can find out if maybe this might actually be a pretty decent price. Coming now into the dividend summary, this company does pay out a dividend, guys, with a current yield of 4.86%. Now that is pretty massive, but that mainly has to do with the fact that the share price has fallen a pretty big amount. If this thing was at around like the $78 mark, I would say that this might have been at around like 2%, maybe close to that of like 3%. But because it has fallen, it is at 4.86, which is pretty big. This ends up being 50 cents per share, which ends up being an annual payout of $2 per share. Payout ratio, now in regards to the free cash flow, it is 66.33%. So this right here is already a little bit high for my taste. We're going to see what the free cash flow tells us though. Now, while this is a little bit worrying, their 5-year CAGR, guys, it is 5.34% with 48 consecutive years of dividend payment. Guys, they're almost a dividend king. 2 more years and they get that dividend king status. So let us cross our fingers that maybe they're able to sustain this dividend for 2 more years. But we'll see that in just 1 second. Now, ex-dividend day is actually coming up as well on September 9th. So if you guys would like to get this dividend, you can still get it, assuming that you buy it before September 9th. Payout day is actually going to be on September 20th. And of course, they pay their dividends quarterly. Let us now come, guys, into the calculator. We got the ticker symbol of VFC, market cap of $16.1 billion with a PE of 16.18. So basically, the PE is telling me that, well, it might actually not be a pretty bad price, guys, at $41.43. As we just saw, it is at 52-week lows, essentially. Now, in regards to this dividend of $2, well, let's actually compare this now to the shares outstanding. And based off of that, we can see that they essentially pay out a year $777 million in dividends. Now, in regards to the free cash flows, guys, the 5-year average and last year's free cash flow, unfortunately, this is no good. Well, as of last year's free cash flow, they're at a negative $254.36 million. And as of last year's free cash flow, it is a little bit better, but still in the negative at negative $158.1 million. These payout ratio, guys, come out to be at 125.55%. And the 5-year average is at around almost 150. So guys, as it stands, well, this dividend may not be as secure as you may want it to be. I get that they're almost dividend kings, but the last time we actually saw a company like this, I remember it was Rio Tinto, where I believe that their payout ratios were like above 120% or at least above 110%. And I even said, hey, this may have a possibility that their dividend may get cut. And it actually happened. Their dividend did get cut. Rio Tinto did cut its dividend. So we may see something similar when it comes to this. So do not buy this company solely for this dividend. Get ready for it to be cut or suspended at any moment. So let us now come over here, guys, to the fundamentals. Starting, of course, with the net income. We got 5 years ago of $1 billion to 1 year ago, guys, of $1.4 billion. That is an increase of 37%. And, well, this graph tells us a whole lot. For starters, it is not consistently increasing as I would like it. However, it is going up on the 5-year. Now we see an anomaly here where from 4 years ago to 3 years ago it went down, and then from 3 years ago to 2 years ago it went down again. Now this one of 2 years ago kind of makes a little bit more sense because of the whole COVID situation. But what doesn't make sense, guys, it is essentially this 3 year ago number. Why did it go from 1.3 billion to 679.4 million? That is a massive drop, right? So this is one instance that I highly suggest everybody, if you're interested in this company, please figure out what caused these anomalies. If you're over here looking at the free cash flow, we can see something very similar one more time, where 3 years ago they did go down, just like we see here with the net income. So if you guys see these anomalies, and of course if you're interested in this company, I am not going to show you guys what caused this downturn. I am here to point out, hey, something happened here. Go out and find out, if you want, what exactly happened these years that made their net income go down. That's essentially my role when it comes to making these videos, is to show all of you guys a process, to point out like, hey, this is what you want to look for. And clearly anomalies happen. Okay, if they're not clearly explainable, like this 2 year ago number, for example COVID, then again you may want to do more research on it, assuming that you still want to buy this company. So as it currently stands, guys, it is an increase on the 5-year, but it's not consistently increasing, mainly because of these 2 years. But if you see here, well, we can see that they did grow pretty consistently from 4 to 1 year ago. Just what I mean by that is from 4 years ago, skip these 2, and then 1 year ago, assuming that these 2 never happened, you can see that it is pretty consistently increasing. So for that reason, guys, I'm actually going to give this, believe it or not, around like a 50%. Now, assuming that you guys can explain this situation right here 3 years ago, then you might actually say that this might be higher or lower. But this is essentially what I'm going just by looking at this for the first time. Coming down to the free cash flow, the most important of all the profit metrics, cash from operations less your capital expenditures. Guys, this is what companies use to pay out that dividend, that massive dividend of 48 consecutive years with an almost 5% yield. Yeah, guys, if you want that thing to be sustainable, you want this thing to, of course, be positive and be increasing. Now, we did see that in regards to their 5-year average free cash flow and their last year's free cash flow in regards to this dividend, they cannot sustain this dividend, and we can clearly see this here. 5 years ago, guys, they were at negative $1.15 billion to 1 year ago of $619 million. On the 5-year, guys, this is an increase of 154%, with a 5-year average of $522.64 million. So first of all, there are a lot of stuff here that just screams red flag. For starters, the 5-year ago number, negative 1.15 billion. Okay, figure out what happened here, guys, because if we actually come over here to the fundamentals tab, we can see that their cash from operations is here, capital expenditures is here. This year, the 5-year ago mark, it's not that the capital expenditures exceeded their cash from operations. No, it was actually that the cash from operations actually went negative by $972.9 million. That is not something that you want to see. Now, they did recover it fairly decently on the 4-year ago as well as the 2-year ago. But even then, guys, it is very peculiar as to why they did negative cash from operations 5 years ago. Now, let's extrapolate this even further. Once we get this year's numbers all the way, this 5-year ago number will essentially go bye-bye. Assuming that this year's numbers are on par with 1 year ago, as well as lower than this 4-year ago number, this would be a decreasing cash flow, guys, which is not something that you want to see. This pretty much explains as to why this dividend cannot be sustained. Just by looking at this cash flow, they're nowhere, right? They're essentially nowhere. If anything, they're decreasing it from what we see right here. So for that reason, guys, I'm gonna have to give this a really low score of, well, I don't want to go with 0%, but I may just have to go with like a 10%, because this is a massive negative free cash flow right here. I just cannot excuse that at all. Looking now at the revenue, we got 5 years ago of 11.5 billion to 1 year ago of 11.8 billion. That is an increase of 3.04%. So not that big of an increase. And on top of that, when we look at this graph, we could see that, well, they were essentially going nowhere, right? From 5 to 4 to 3 years ago, well, from 5 to 3 years ago, they were essentially going down. They did go up from 4 to 3, but I mean, just guys, overall, the normal trend, it is essentially to be going down. Now, obviously, 2 years ago, they did have COVID, so this explains as to why they went to 9.2 $2 billion. And sure, 1 year ago, they did go up to $11.84 billion, you know, surpassing their 5 year ago number. But just by looking at the whole entire picture, you can see that they have not gone anywhere when it comes to this. So for that reason, guys, I'm actually going to give this at around like a 30, maybe even like a 35%. Again, not consistently increasing. They beat from 1 year ago to 5 years ago. That's about it. That's all they really have going for them, right? They did go down 5 years ago to 4 years ago. So yeah, it really just, I have to give it a 35%. I don't really see anything good when it comes to this revenue. Looking now at the balance sheet numbers, we got assets minus the total liabilities. Can this company's assets surpass their liabilities? Because if they can't, then we have a pretty big problem on our hands, right? If a company's liabilities exceed their assets, this means that if things were to really hit the fan, and things might actually be hitting the fan right now, they may actually go bankrupt. This is not something that you want, because then you will lose all your money. At that point, no amount of dividends will be able to do anything for you. Currently, they're at $3.4 billion. And, you know, at least they're in the positive. But looking at this graph again, guys, it is a downtrend overall, right? Even during COVID, I get as to why they went down to around 3.1 billion. But 3 years ago, guys, they were at 3.4 billion. But 4 years ago, they were 4.3 billion. And even 1 year ago, they still couldn't make it past this $4.3 billion mark. They barely reached $3.5 billion. So as it stands, this is not good at all. Now, if we take a look at the average total assets, we get around $12 billion. Average liabilities, we get around $8.5 billion. And doing this difference, we get $3.5 billion. So it is still in the positive. Okay, good. At least these are not in the negatives, but the downtrend is concerning. So for that reason, I'm going to give this, I'm not going to give it a really low score, but I'm going to have to give it like a 55%. Just because it's not something that I'm really looking for. I want consistent assets minus liabilities growth. I want the assets to be really increasing, pacing out their liabilities, because in this case, well, if things get more difficult, this will get closer and closer to zero, if not in the red. And speaking about red, let's take a look at the cash flow minus the liabilities. Basically, we're going to do the exact same thing that we just did in the last graph, but instead of assets, let's do the cash flow year over year and then subtract that minus the liabilities. And normally what I find with this is that companies tend to be in the negatives. But what you at least want to see is, okay, are they at least getting their cash flow faster growing than their liabilities growing? Now, we did look at their cash flow, right? And it's not doing too good. And we just took a look at their assets minus liabilities, and we can see that this isn't doing too good either. So it's not a surprise that as of 1 year ago, guys, they're at negative $9.2 billion. 2 years ago, they were at negative $9.6 billion. And ever since 4 years ago, they have just been getting further and further in the red. So it really is concerning. Now, they did go up a little bit from 5 years ago to 4 years ago, and 2 years ago to 1 year ago, but it's just isn't showing the trend that I like. The trend is still going down. So it's unfortunate, but this is, again, a really low score. If we take a look at the average cash flow minus the average total liabilities, we get around negative $7.7 billion. I'm going to give this, guys, essentially like a 30%. Again, overall trend is just going down. I do not like it, so 30% I think is justifiable. And now looking at the most underrated of all the metrics, the shares outstanding. Guys, most people don't take a look at this. Here in this channel, we take a look at this because if a company pays out a dividend, you want these shares to be going down. And just in general, you want shares to be going down because of the fact that, well, they give you a bigger stake of the company by you doing absolutely nothing. Now, recently, a bill did pass that increases the share buyback tax by around 1%. So this may disincentivize companies to, buy back shares, which is unfortunate. The people in Congress don't know anything about economics, which is why they're in Congress to begin with. But nonetheless, guys, shares outstanding, you essentially want this thing to be coming down. And when it comes to this company, we see 5 years ago of $394.3 million to today of $388.5 million. Now, this is a little bit of a decrease in the 5 year of around 1.5%. However, from the previous to the current year, this is looking at 1 year ago of $388.3 million to today of, again, $388.5 million. This is a little bit of an increase, around 0.05%. Now, okay, sure, this is good. At least they're decreasing it on the 5 year. It is a decrease. but you know, anything between 1 to 5% or anything above 0 to 5%, I just feel that they were just doing it because they really just wanted to do it. It really wasn't like a reason to do it. They were just like, yeah, let's just do that just because, right? It's not like a massive decrease that we just saw yesterday with like HP, right? HP was massive decrease. This is more just like, yeah, okay, it's nice, I guess, but it's not anything that's going to benefit us at all. So overall, it's good, but at the same time, it's not what I would like to see. On top of that, if we actually take a look at these individual numbers over here, we can see that they did issue a couple shares here and there throughout the years, right? From 5 years ago to 4 years ago, they did increase it. Then from 3 years ago to 2 years ago, they increased it again. And then from 1 year ago to today, they increased it again. So it's not consistent decrease either. So for that reason, guys, I'm going to say I don't necessarily know for this. This was a tough one, actually. I'm gonna say at around like 60%. I would say it is a decrease in the 5 year, and I guess they're consistent with some years increasing it and then the following year and then the following 2 years decreasing it. So I'm gonna give it, guys, a 60%. And now lastly, when it comes to the cash and equivalents, they currently hold $528 million with an average cash of $845.3 million. So now let's actually take a look at the overall grades when it comes to this company. Net income, I gave it a 50%. Free cash flow, 10%. Free cash flow was awful. Remember that negative 5 year ago value was awful. And on top of that, it wasn't negative with the capital expenditures, it was negative with the cash from operations, which is even worse. Revenue was 35%, assets minus liabilities 55%, cash flow minus liabilities 30%, and the shares outstanding 60% for an overall grade, guys, of 37%. Yeah, it's not anything that I like. Honestly, the fundamentals aren't that good. There are better ones out there, so it is what it is. 37%. Let's actually see if at the current share price we would actually like to buy this company using discounted free cash flow. So let's come over here, let's make 3 assumptions, low, medium, high, using of course 3 different factors: revenue growth, the predicted share buyback, and the required rate of return, which I like to personally keep at 10%. Now, before we even move on with this, guys, you're probably looking at these numbers and you're like, why are there negatives? Well, it's because they have a lot more debt than they do cash on hand. That's just it. But let's actually extrapolate this into the future with a certain revenue growth, and maybe these negatives will actually turn into the positive. But as it currently stands, guys, look at this. These values are already telling me that it's at $12. So I know a lot of people might be like, the PE is already at like 16.18. If this thing falls to like $12, the PE will be like nothing. I'm like, well, here's the thing, guys. Discounted free cash flow uses cash flow and revenue growths. PE doesn't, right? PE just takes the current price and then divides that by the current earnings. It doesn't extrapolate into the future. I am extrapolating into the future. So that's essentially what that does. Now let's actually come over here to Seeking Alpha's Growth tab, and we can see that revenue growth forward is 12.3 and the revenue growth year over year has been around 15%. So let's actually make these assumptions with the low one. Let's actually say at around 10%. Let's go really low ball it, 2% less than what the forward one is saying, right? Now for the medium one, let's go at around 12%, which is on par with what they're saying for the forward revenue growth. And for the highest one, let's go another 14%. So it's right under the revenue growth year over year, but it is still fairly bullish in my personal opinion. Now when it comes to the predicted share buyback, guys, well, we see that they have been buying back at around 1.5%. I don't know if they'll continue to do this. I really don't know. But let's just assume that they will, because, well, we haven't seen much of an increase, at least on the 5-year scale. There has been increases in individual years, but in the overall grand scheme of things, it looks like they're like very wary about keeping that 5-year shares outstanding pretty low. So let us say that for the low assumption that they actually buy back around 0.5% of shares. For the median assumption, let's say at around 1% of shares, and for the highest assumption, let's say around 1.5%. So on par with what they're doing right now. Now with this, guys, we do get some target share prices for the low assumption of $17.16, median $18.43, and the high of $19.76. Adjusting for debt, they do have a lot more debt, guys, than they do cash on hand, which explains why this falls all the way down to $3.59 for the low one. $4.78 for the medium one, and $6.05 for the highest one. Now let's take a look at this through a margin of safety lens of 5, 10, and 15%. This puts me between the buy ranges of $3.05 to $3.41. For the median assumption, it is $4.07 to $4.54, and for the highest assumption, it is $5.15 to $5.75. Now guys, the current share price is $41.43. So, you know, based off of the margins of safety as well as adjusting for debt, guys, this is looking fairly low. Now, when it comes to the target share price, not adjusting for debt, it's still pretty low, right? You would still have to wait for it to fall at around like $20 or so. Now, before anybody in the comment section begins telling me how I'm wrong and I don't know what I'm talking about, no problem. I'm going to prove you wrong. Let's come over here to the book value per share. Again, this takes into account zero assumption. This looks at all of their assets that they have on their books and divides it by the current shares outstanding to give us the current share price that the company should be worth. And currently, guys, take a look at this. According to their book value per share, they should be worth at $8.63. As of 5 years ago, they were at $9.35. Even at their peak 4 years ago, it was $10.83. And now, just to prove you guys even wrong, all the haters out there, obviously, that's who I'm essentially talking to. Looking at the tangible book value per share, well, now we get negative $5.13. So, yeah. The fact that my discounted free cash flow, it is pretty much saying $3 to $6 to $17 to $19 or so on. And then I just proved to all of you guys that doing book value and tangible book value per share, which takes into account zero assumptions, I'm essentially, well, the tangible book value, it's in the negative, so, you know, whatever with that one. But the book value actually tells me that it's around $8.63, which falls right out of my high assumption, which, again, all of these numbers can change just based off of these assumptions that I made over here when it comes to the revenue growth, projected share buyback, and the required rate of return. So as we can see right here, guys, everything changes based off of these numbers. That's why in every single video I always have to say, please do not follow what I am saying. Please have these calculators for free. This is not financial advice. Every investment is the present value of all future cash flow. As I just said, I have all of these calculators for free. Have them, make your own assumptions. You guys could take a look at all of these graphs, you know, make sure that you know what you're talking about. You guys also have the weighted grades tab, just so that way you can see what the overall grade you would give it for a company. You guys can change pretty much anything that you see here, the margin of safety, the required rate of return. When it comes to this, you guys can change these weighted grades as well to whatever you guys want. You guys also have a book value calculator, which I just showed all of you, as well as a reevaluation calculator and even a dividend tracking sheet. So please have all of these things all available for free. All I'm asking for in return, guys, is just one little thing, and that is just please help me grow my channel. Thank you so much for everybody who have subscribed. I really do appreciate it. Like, as of today, I think as I'm recording this, we are up to 934 subscribers. Guys, if we could make it to 1,000 by the end of September, that would be crazy. At 1,000 subscribers, I really do have a pretty, at least what I think is a pretty good video planned out. And I might even make it like a two-parter. I may even do like an AMA, like a live stream AMA, or like I'll put a video where you guys, I could just be like, you know, leave questions in the comment section and I'll answer them, you know, whatever. So please, if you like this kind of content, if you like the kind of value I bring to you guys by giving out for free these calculators and showing you guys a process on how to invest, all I'm asking for in return, guys, I'm not asking for Patreon money. I'm not asking for to subscribe to like my course or anything like that. I just want a simple like, subscribe, and comment. That's really it. Just help me grow my channel. Thank you all so much. I really do appreciate it. Now let's actually take a look at these dividends, guys, because, well, at $2 per share, even though we see that they cannot afford it in accordance to their cash flow, let's just entertain this a little bit. Let's say that you make the average monthly US income of $5,725. If you were to put in 1 month's income into this company at the current share price, which, you know, in accordance to my assumptions here and even the book value, it is overpriced. but we are at 52-week lows on top of that. This would essentially buy you 138.19 shares. At the current annual dividends per share, take a look at this, guys. This buys you $276.38 annual dividends, quarterly dividends of $69.10, and a monthly dividend of $23.03. So not too shabby. Let's put this at 2,000 just to see how much this would get you annually, and you can see it's essentially almost $100. So for $2,000, you would increase your annual income by $100. That's not too shabby, guys, in my personal opinion. Now, unfortunately, as we just saw, they cannot afford this dividend. You are at risk for this thing to be cut. So be wary when it comes to buying into this company. If you want to dividend harvest or do whatever you want, that's fine. I'm not going to tell you what to do. Again, not financial advice. I'm just showing you guys that this dividend may get cut in the very near future. All in all, thank you so much for the stock recommendation of VFC. In my personal opinion, it's not really that good. I mean, we took a look at their fundamentals. That cash flow is bad. Just from this alone, from just this dividend sustainability, they can't sustain it. It really is sad, but they really can't sustain it. So I would give it a pass for this one. I know that they're an apparel store, but in my personal opinion, there are better ones out there. That pretty much does it for this video. If you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my YouTube sites. Link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.